2024 is here, and if we're not prepared, we might get hit like we did in 2020. We all got complacent, and eventually, we suffered market crash after market crash. Some of us haven't even financially recovered yet. But today is not the time to mourn for what we've lost. Let's start the year right. Welcome back to our channel Passive Income, where we turn dreams into streams of income. Today, I'll teach you how to make millions in 2024 through the stock market. If that excites you, let's get on with it. Picture this: 2024, a canvas painted with opportunities but shadows of potential market crashes lurking in the background. It's not just about making gains, it's about safeguarding what you've got. Let's sift through the insights from financial powerhouses like JP Morgan and Goldman Sachs, decoding the intricate dance between risk and opportunity. Navigating risks with strategic investment. Now let's delve into a real-life scenario to illustrate the art of strategic navigation in the world of investments. Picture this: it's the brink of a geopolitical crisis. Tensions between major global players are escalating, and financial markets are starting to reflect the uncertainty. News headlines are causing stock prices to swing wildly, creating an atmosphere of unpredictability. In this scenario, our investor, let's call them Alex, recognizes the need for a strategic dance with risk. Instead of succumbing to the market's turbulence, Alex decides to strategically navigate through the storm. Diversification becomes the key move. Alex assesses their existing investment portfolio and identifies potential vulnerabilities. They notice a heavy reliance on tech stocks and other assets susceptible to geopolitical fluctuations. To counterbalance this risk, Alex strategically allocates a portion of their portfolio to assets that historically perform well in times of uncertainty: gold and defensive stocks. As geopolitical tensions escalate, traditional stocks experience volatility. But the defensive assets in Alex's portfolio, like gold and stable utility stocks, act as a buffer. While the overall market takes a hit, Alex's diversified portfolio not only weathers the storm, but even showcases resilience. The strategic move to dance with risk rather than avoid it positions Alex's investments not just to survive, but to thrive amidst uncertainties. This real-life scenario underscores the importance of proactive strategic thinking in the face of market turbulence. By having the foresight to diversify strategically, investors can navigate risks and position themselves for stability and growth, even in the most unpredictable economic climates. Remember, it's not just about high risk and high reward. It's about making intelligent moves that ensure resilience in your investment journey. Dollar cost averaging in turbulent waters. Now, let's demystify the hero of the hour: dollar cost averaging, and explore how this approach can be your financial compass in the unpredictable world of market roller coasters. Imagine you're standing at the edge of a turbulent sea, a market characterized by highs and lows, twists and turns. Instead of diving in with a lump sum investment, let's break down the how-to of dollar cost averaging. Instead of making a substantial one-time investment, opt for consistent, smaller investments over time. This strategic move is akin to navigating the turbulent waters with a well-guided compass. The idea is to shield yourself from the impact of market ups and downs. Let's say you have $10,000 to invest. Rather than investing the entire amount at once, you decide to spread it out over several months or even years. For instance, you invest $1,000 every month. This way, your investment strategy adapts to the market's unpredictability. During periods of market lows, your fixed investment buys more shares, maximizing your returns. Conversely, during market highs, you purchase fewer shares. This intelligent approach ensures you're not overly exposed to the volatility of the market, as you're consistently adjusting your investment based on its performance. The beauty of dollar cost averaging lies in its ability to smooth out the impact of market volatility. By consistently investing over time, you avoid the pressure of timing the market perfectly. This strategic positioning minimizes the risk associated with investing a lump sum just before a market downturn. Over time, as you continue this disciplined approach, you benefit from the average cost of your shares. Regardless of short-term market fluctuations, you're strategically positioned to weather the storm and potentially emerge with a more resilient and profitable portfolio. In a world where market roller coasters are expected, dollar cost averaging emerges as the beacon of financial stability. By breaking down your investments into consistent, smaller amounts, you not only shield yourself from the impact of market ups and downs, but also position yourself strategically for whatever unpredictable twists the market throws your way. Defensive moves in uncertain terrains. Amid economic uncertainties, defensive moves step into the spotlight as unsung heroes offering stability and growth opportunities. Let's delve into sectors and stocks that not only weather economic storms but also serve as anchors in the unpredictable seas of the financial market. Picture yourself navigating through the unpredictable seas of the financial market, where economic uncertainties are akin to stormy weather. The business idea here is to strategically invest in sectors that act as anchors, providing stability and growth even in turbulent times. Consider directing your investments towards recession-resistant sectors such as healthcare or utility stocks. These sectors have a historical track record of remaining relatively stable during economic downturns. Now let's break down how this defensive move works. Imagine utility stocks as a sturdy anchor, holding your portfolio steady when economic seas get rough. Utilities, providing essential services like electricity, water, and gas, are known for their defensive nature. People still need these services even in a downturn, making utility stocks a defensive play in uncertain terrains. The goal is not to eliminate risk entirely, but to strategically mitigate it. By diversifying into recession-resistant sectors, you add a layer of stability to your portfolio. This approach ensures that even if certain sectors face challenges, your overall investment strategy remains resilient. In a world of economic uncertainties, defensive moves play a crucial role in navigating turbulent waters. By strategically investing in recession-resistant sectors like healthcare or utility stocks, you not only safeguard your portfolio, but also position yourself for stable growth. Think of these defensive moves as anchors, providing stability and resilience in the face of unpredictable financial storms. As we step into 2024, envision it not as a static painting, but as a dynamic tapestry of market conditions. In this ever-changing landscape, the key to success lies in flexibility, seizing opportunities during market dips and exercising caution during potential downturns. There's no one-size-fits-all approach. Your strategy should dance to the beat of your financial goals and risk tolerance. Picture a scenario where the market takes an unexpected turn due to unforeseen circumstances. This challenge requires an adaptive strategy, one that involves staying informed, regularly reviewing your portfolio, and being open to adjusting your investment allocations based on the evolving market conditions. The key to overcoming this challenge is adaptability. Regularly stay updated on market trends, economic indicators, and global events that might impact your investments. Being well-informed positions you to make proactive decisions in response to changing market conditions. Conduct regular reviews of your investment portfolio. Assess the performance of individual assets, sectors, and the overall market. Identify areas of strength and weakness to make informed decisions about adjusting your investment mix. Be open to adjusting your investment allocations. If certain sectors show signs of strength or weakness, consider reallocating your assets accordingly. This flexibility ensures that your portfolio remains aligned with your financial objectives. To navigate the dynamic landscape successfully, try these things. 1. Regular reassessment. Periodically reassess your financial goals and risk tolerance. As life circumstances change, your investment objectives may evolve. Regular reassessment ensures that your strategy aligns with your current financial situation and future aspirations. 2. Stay informed. Stay abreast of market trends and global events. A proactive approach to information gathering positions you to anticipate potential market shifts and make timely adjustments to your investment strategy. 3. Flexible mindset. Cultivate a flexible mindset. Recognize that market conditions can change, and being open to adjusting your strategy demonstrates adaptability. This mindset is essential for navigating the uncertainties of the financial landscape. In the dynamic year ahead, adaptive strategies are the linchpin of success. Navigating unforeseen market shifts requires staying informed, regularly reviewing your portfolio, and being open to adjusting your investment allocations. By embracing flexibility and proactively addressing challenges, you position yourself to thrive in the ever-evolving financial landscape of 2024. If you found value in this exploration of strategic investment approaches, don't miss out on future insights and guidance. Subscribe to the Passive Income channel for ongoing discussions on wealth building, financial strategies, and investment wisdom. Hit the like button if you enjoyed this content, share it with others who might benefit, and make sure to turn on notifications to stay updated with our latest releases. Your journey to financial empowerment starts here. Subscribe now, and let's thrive together in the world of passive income.